If no one has said it to you yet, happy 2026. My name is Dano Weir. I'm the marketing director for Sonoma Wealth, Fermata Advisors, and we are going to go on the markets. Holiday for some people, kind of extending New Year's Day into a bonus day here, but not for the market and not for us. You did survive the robot-pocalypse of 2025, which may still be coming in 2026 and every year thereafter. But we might be throwing it back, way back to the gold standard, it feels like. Did AI overspending lead to a knee-jerk reversion to precious metals now and perhaps this year? Also, we're going to look at, trend or not, the money was spent. So what was the impact on GDP from all that AI investment? And Chris, one of our managing principals, has been digging into a great book, what he's learning from the 1920s and 30s markets that could be ringing even truer today than ever. And Daren has thoughts on oil and bonds as we start the year. And let's start the show.
The stock market, the economy, your money. What's the latest and what could be next? Find out now with Fermata on the markets. Straightforward financial market updates for the brands of Fermata Advisors, Sonoma Wealth Advisors, Fermata 401k, and Fermata Tax. On the Markets starts now.
Let's get them in here for our episode. Will an artificial 2025 lead to a tangible 2026? They are the managing principals of Fermata Advisors, Sonoma Wealth, our private wealth brand, Daren Blonski and Chris Sipes. Daren, how was your Christmas? Tell me one cool thing that happened.
One cool thing. There were so many, Dan.
We can't go all day.
The coolest thing that happened, Dan, and this. Have you ever seen the movie Four Christmases?
I have not, but it's Vince Vaughn and Reese Witherspoon, right?
Yeah, and so it's about Vince Vaughn, Reese Witherspoon both have divorced parents, and they have to travel between the four sets of parents during Christmas. And early on in my life, that was the way life was. And it was like kids and four parents. And, oh, man, Christmas was just a gauntlet, as was Thanksgiving. And everybody had to see on Christmas. And it was wonderful to have a big family and be able to spend time with them. Looking back, I wish I would have appreciated it even more. And due to unfortunate circumstances, my family was just like decimated over the last few years. And, now there's like one set of parents to see, which is tragic in its own right. But, you have to see the golden lining through everything in life. And one of the greatest things I had this Christmas that I just enjoyed is I didn't go anywhere. I just stayed home. It was fabulous. So that was a great thing about Christmas.
Chris, what about you?
Well, I was put in charge of cooking the tri-tip for I don't know how many people, a lot of people. There's a lot of pressure, Dan, and it came out great. So I was stoked about that.
Did you feel like your manliness was like manifested and everybody
down the line
around the dinner table and said, Chris is a real man. He can cook.
Anybody that knows me knows that I love to grill. And so that was great. But sometimes the pressure's on when you got that many people waiting for their tasty tri-tip. And so that came out great. And the universe is teaching me to deal with defeat and loss, because my Buckeyes lost this week to Miami. So I'm enjoying the personal growth that I'm going through at the moment to get through this.
I wasn't going to say anything, but
sure.
I didn't want your loss to stick to me and my Niners, so I just kind of was leaving you alone,
Yeah. It'll make
you got a big one Saturday tomorrow.
Yes, I do.
That's going to be quite the game, Dano. I'm actually going to even watch that
game. If the 49ers win that game, they will potentially not leave Levi's Stadium all the way to the Super Bowl, including the Super Bowl, were they to make it that far, because the Super Bowl is literally in Levi's this year in San Francisco, San Jose. So that would be amazing.
Nice.
Yeah. Well, I'll share one more thing.
Not leave. What does that mean? Are
If
they
the
talking about
Niners,
leaving Levi Stadium?
no, like they would be a home playoff game for every round of the playoffs because they would be the highest seed should they advance that far.
Oh God.
And then very very uniquely, the Super Bowl is usually played in a random city, and it happens to be their city this year. So that would be quite fortuitous, but we shall see.
Levi Stadium is awful, by the way. I am not a fan.
It could have been worse. I'll say that. It could have been
It could
worse.
have been worse. You mean if
At
you
least
weren't parking on a golf course when you go there, or what?
it's not one of those indoor spaceships like every other stadium has now. Kansas
Okay.
City's building a spaceship. Vegas has a spaceship. They're all building these spaceships these days. So there you go. There's my fun thing from Christmas. My team's doing well. Chris, what do we got here? First meme up.
Yeah, so 2026. I got a chuckle out of this. I think this is from the New Yorker, so hopefully they're not suing us for using this. But it's got a couple guys, looks like from maybe Roman times, and it says, "There I go, still writing BC on my checks." I thought that was hilarious.
Yeah.
So yeah, good luck to everybody trying to remember to write down the right date for the month of January.
I did it right today. I had to do right my first day. Actually, we were on a call when I did today, Chris, and I wrote
Nice.
2026, and I was like, I got it right. Yeah. This year's starting off good.
So
Yeah.
nerd alert, but most financial data are considered to be like strong financial data. The FAMA French data, etc., goes back to 1926. So now we can say we have 100 years of this, better data. Now that we're in 2026, so that's kind of cool. But you guys know I've been reading that book, Investing in U.S. Financial History, by I think it's Mark Higgins. Excellent. I'm really enjoying it. Got this quote that really made me laugh, given, we talked so much over the last few years about unprecedented times. Fundamentals don't seem to matter anymore. So many relationships that economically have mattered for a long period of time don't seem to apply anymore. And this quote was referring to Charles Merrill, who was the founder of Merrill Lynch back in the 1800s. And he says, in March of 1928, the firm, which was referring to Merrill at the time, wasn't quite Merrill Lynch yet. In March 1928, the firm was in a strong financial position, but Merrill sensed danger on the horizon. He feared that lax monetary policies had driven stock prices to dangerously high levels, and he encouraged clients to trim their exposure. Despite his warnings, the stock market continued to rise for the remainder of 1928 and most of 1929, prompting relentless ridicule by Merrill's friends, colleagues, and journalists. The criticism was so unbearable that Merrill questioned his own sanity. It took several consultations with a psychiatrist before he was convinced that he was not losing his mind. Despite the unpopularity of his beliefs, Merrill persuaded the partnership to substantially reduce the firm's exposure to stocks well in advance of the Great Crash in October 1929.
Oh man, Chris, this is right in your wheelhouse, man.
That one cracked me up. So for those that don't know, 1929 is considered the beginning of the Great Depression. And specifically, it started around October of 1929. And so he started to feel like things were getting a little crazy in the spring of 28. So he only had to wait like a year and a half. But he literally thought he was going crazy. He went to a psychiatrist. That just cracked me up. I couldn't believe it. Then there was this other little nugget in there. And this is talking about rebuilding the global financial system after World War II. And this is actually, talks towards the end of like 1943, when the Allies felt that they were putting together the Bretton Woods Agreement, and they figured that the Allies looked like they were going to win the war, and they needed to come up with a global financial system. And that's the kind of the context of this. And it says, There was urgency assigned to this task because policymakers believed that the dysfunctional trade policies of the 1930s, collectively known as beggar thy neighbor policies, had caused the war. The tragedy of these policies is that the leaders of each individual country genuinely believed that trade barriers would benefit their people. By increasing the price of imports and reducing the price of exports, they hoped to stimulate a recovery of their domestic economies. This, in turn, would create a favorable trade balance, lower unemployment, and end the Depression. So obviously that didn't happen, and there were a lot of economic things that led up to World War II. And so interesting that, this has happened before. And for those that might be familiar, if you're not familiar, look up The Prisoner's Dilemma, and it's part of game theory. And it kind of explains how, even though you might be doing what's best for you, like in your immediate concept of what's best for you, it can actually turn out to be a disaster because of the way that the game ends up playing out. So look up The Prisoner's Dilemma if you're interested in that, and it's quite interesting. So recapping 2025, where did we end? We've got the major asset classes here. Gold, obviously the top performer by a mile, which we'll talk more about a little bit, but followed by emerging markets and developed stock markets, both up in the mid 30% there, or low 30%, sorry. We had the S&P at about 17.7, so another good year for the S&P. And then you've got bonds and long-term bonds in there as well. So another good year for the markets. And it seems like we've strung together quite a few of these here outside of 2022 with the brief downturn in stocks and bonds. It's really been smooth sailing for stocks over when you look at it over the long term. Now, anybody that was actually invested during those periods knows that there was some sprinkled in times of absolute panic. COVID. We had the tariff tantrum earlier this year. So markets tend to, have the, what do they call it? The escalator up and then the cliff down, and that tends to happen. So there's always going to be a narrative around the way up and a narrative around the way down. And we as humans obviously get bought into those stories. So these squiggly lines, they look so easy in hindsight, but when you're actually going through it, it can feel quite different from an emotional perspective.
Daren, what's that blue squiggly line at the very, very top, separated away from everybody else by like a double or a triple margin? Is that?
I'm not going to say.
Is that?
I didn't even put silver on here because I didn't want it to throw off the graph. Gold did bad enough at that. So
gold. That's gold.
So interesting, too, with that financial history.
What a bunch of cherry-picked numbers, though, Chris. I mean, you're only showing 1 year timeline here for Bitcoin. Right? Just put the 10-year numbers on, Chris. Put the 10-year number and the 5-year and the 3-year. Let's go.
Yeah, we should. Somebody, I forget who mentioned this, but it's like one of the first years since Bitcoin's been tracked where it wasn't either the absolute top performer or the absolute bottom performer. It was kind of, so that's interesting.
Kind of like did nothing.
Yeah. I mean, down 6 sounds bad, but like really it's that's nothing. Okay, so where are we sentiment wise going into 2026? We ended the year pretty high bullish numbers, 42% bullish according to AAII. CNN is at 43, just slightly in the fear zone, which was down from 52 of neutral last week. And then you had Bitcoin at 28 fear. Last week it was at 20 extreme fear. That one seems to follow, like all these sentiment indicators follow price. And we got a little jump in Bitcoin this week. So a little less fearful than it was a week ago. All right. So fun stat from Charlie Biello. And Biello, I love his way of quoting things sort of like sports, like especially baseball. I feel like there's always, stats that the announcers are throwing out, or
I have a
ESPN will
man
throw.
crush on Charlie Biello.
I do. It's really
Maybe
It's a
just
tie
Charlie.
between
Maybe
it's a
Charlie.
tie between Charlie and Mike Siccardi. He can't
Yes.
decide
So
which.
you got to Med Faber. I mean,
Oh,
like,
well, of course.
we got to throw Med
Yeah.
Faber in.
Yeah, there's a few of the greatest hits, right? So Charlie says U.S. large caps outperformed, and when they say large caps, that means big companies, so large market capitalization. So when you take all their shares and you add it up, the price of those shares, there's a total value of the company. And so large caps outperformed U.S. small caps by 5% in 2025, their fifth straight year of outperformance. That ties 1994 to 1998 for the longest streak of large cap outperformance ever. That prior streak was followed by 6 straight years of small cap outperformance. Now it's only one day, but we got quite the pop in small caps today to start the year off. So hey, maybe this is the finally the year for small caps. We'll see. Then we talk a little bit about interest rates. Here we are looking at the 10-year Treasury in dark blue, the 30-year Treasury in green, and the mortgage rates in gray. And mortgage rates did come down just a little bit during 2025. You can see we were probably right around 7% to start the year off, and now we're just hovering above 6%. And then you look at the longer-term Treasury rates; they're down slightly. 10-year probably being the most important for a credit kind of benchmark. And we're talking a little bit about this before the show. The reason for this is most credit is based off of the price of Treasury rates. And that's because Treasury rates are considered the credit risk-free portion of the fixed income market. And so when investors look at the landscape, they say, I can go here and make sure I'll get my money back, or I can invest in things like mortgages. Well, if I'm going to invest in things like mortgages, I should get paid a little bit more since I'm taking on the risk that I might not get paid back. And you're taking on prepayment risk and things like that, because if interest rates go down, people tend to refinance, and then you've got to figure out what to do with your money after that. So it'll be interesting to see what happens with rates going into 2026, given that Fed policy is probably going to be more accommodative, meaning they're lowering interest rates. However, that only matters in the way that the markets turn around and price the longer term debt, because the Fed does not control the 10-year Treasury rate, the 30-year Treasury rate, at least not yet. So Goldman Sachs, excuse me, guys, I'm dealing with a cold. I think my immune system after the Buckeyes lost just gave up and gave up the fight. I got cold after that. So
that's the other gift of seeing family at Christmas too, by the way, illness.
Yeah. Well, and I jinxed myself by saying, hey, we made it through Christmas with no sickness, and boom. So
I figured out the secret to Christmas, because for a long time I'd be so looking forward to, like, hey, I'm taking a couple weeks off. I'm just going to enjoy being, whatever, and so excited, and then boom, just get sick. Boom, get sick. So here's the secret. You just tell your mind you're not taking it off. I don't know what you're talking about. I'm not taking it off. And then you're sick. It's quite great.
That works just as well as anytime Daren tries to take a vacation. There's some sort of incident. There's a tariff incident. There's a flash crash. You're not allowed to take vacation.
This is true. Well, Goldman Sachs came out with some great research on AI, and this is part of their projections for 2026, I believe. I was surprised to learn, given how much of the narrative is based on AI right now, that their assumption is that AI's impact on GDP is just under 0.5% this year, and that's their projection for next year as well. And so in terms of impact to GDP, at least according to Goldman Sachs, AI has not yet had that much of an impact on GDP within the US. Now, that would sort of make sense given that markets are forward looking and they're going to price in growth before it happens. So in some ways, you wouldn't expect to see that AI impact on GDP yet, but nonetheless, at least for me, the number was lower than I expected it to be in terms of total contribution to GDP. Now, this was also surprising to me when you look at the total spending on AI versus some of the other build outs that we've done. We might just be getting started. So on this spectrum, you've got the railroads in the UK in 1860s and the US in the 1880s. So these are measured as a percent of GDP. So whenever you hear like a number, like we're going to spend $1 trillion on X, you really want to know those things relative to something else to give you an idea if that's a lot or a little, because we deal with such huge numbers now that you need to know what that is relative to something. And so in this case, it's relative to GDP. And you can see that we really are just in the beginning innings, according to Goldman Sachs. If AI is going to be as big as they say it is, in terms of the spending, we've got a long way to go, even versus what we spent in the 1990s on the internet build out. And they also seem to be pretty sanguine on employment in terms of AI replacing workers. And so they did a survey of their clients, and not there. Maybe over the next 3 years, you'll see a little bit more of an impact on headcount. They're expecting around I guess 11% drop, which would be notable, if that ends up happening. But also not as much as I had thought. I think it's probably too early to tell, obviously, but these projections, don't seem as dire as some that we've seen in terms of expected impact to employment. So we talked, not last week because we missed last week, but the week before that, about the general consensus that the government, the Treasury, the Federal Reserve, will just come in and save markets. And I had mentioned the fact that markets are so large that in order to do that would take a Herculean effort by the government to do that. And this is just showing.
Although, did you see they injected nearly $80 billion over the weekend into the markets?
Yes. And when you look at that in the context of an $81 trillion equity market, 80 billion is really nothing, right? And even if you think about the amount that we put in during COVID, which I believe in the US was like, I don't know, 6 or 7, 8 trillion, something like that. Just the US equity market, we're not even talking about commodities. We're not talking about the fixed income market, which is much bigger than the equity market. Just the US equity market is $52 trillion of the global equity market of 81 trillion. So do policies have an impact on these things? Of course. Can the Fed influence them? Can the Treasury influence them in some ways? Yes. And I mean, if they were to really try to stop, a market that is this large, it's hard to see how you don't get another huge inflation like we did the last time we tried to stop the free fall of a massive equity market. Only now the equity market's way bigger than it was even 5 years ago prior to COVID. So I question whether they could do it. I definitely don't think they could do it without some sort of, downside effects that we can't foresee ahead of time, like inflation. And obviously that's going to lead to more civil issues, just like it did during COVID.
All that
So just
matters is it gets him past the next election, though, man. That's like, I mean, that's the
Unfortunately,
problem.
that's true.
Like, there's no long-term thinking here. It's like, do what I got to do to get reelected, and we'll deal with the problem later.
Chris, this chart is so mind-blowing to me, basically, that the United States, the S&P 500, is 64% of the global equity market. And so we talk all the time about how Mag 7 stocks, the big ones, they have such an impact on the S&P as a whole. Just quick math here. Value of Apple is around $4 trillion. That's about 5% of this pie chart. So basically Japan is Apple, one company. Wow. If they have a bad day, just imagine what that does to the rest of the market.
Absolutely. Yeah. It's this is the largest equity valuation of the global equity market that any one country has ever been. So even when, Great Britain was on top prior to the US, it was never this large in terms of the global equity markets. Japan briefly had a huge run in the 80s, and but the US today is a larger portion of the overall global equity market than any country in history.
That's right, baby. America, huge and bloated. That's how we do it. Everything across the board.
Yeah.
All right.
Now, this stat really blew my mind. I'd heard this before, but I guess just revisiting it, and this is from research done by Bessembinder, and he goes back back to the 1800s, and so he's got a great book, and I can't remember the name of it. Maybe we'll have to look that up. But anyway, it talks about just 3% of companies generated all the net wealth in the United States stock market since 1926. So that's pretty amazing. And that percentage was even lower, in previous years. I think the big run of AI and these large tech companies over the last 15 years has really increased that percentage. But I guess the point here is for those that want to pick stocks and feel that they've got a better mousetrap, or you feel really strongly about a certain company or whatever, just know that the odds are stacked against you. My brother-in-law's words are like echoing through my head, because the day before the Ohio State game, he said something like, "Hey man, the odds for Ohio State in Vegas are the widest they've ever been for a team in a bowl game in history." And I was like, don't tell me that. That's like tempting the market gods, And so just know that the odds are really tough. The market is a huge competitive machine, and very few of the companies survive over time, and very few of the companies provide all the wealth of the market. It's pretty amazing.
Chris is in his feels about his football team, but he's got 3 championships in his lifetime. So, you know what, buddy? You're gonna make it. Okay, I'm just gonna tell you. It's gonna be okay.
Time heals all wounds, right?
Haven't seen a Super Bowl win in 30 years. Okay, just relax. Daren, it is your portion of the show. We've talked about it. We've teased it. The tangible portion of the market: gold, silver, precious metals. Are they the new hot stock of 2026?
It might be the case, but I don't think it has too much to do with AI. I think the correlation is not a causation here on this one, but it sounds like a good teaser when we're doing the show, right? So what I thought we would start off today by doing is talking about the silver market. I mean, wow, silver has just been running crazy lately, and you can't help but ask, but why? And so there's lots of discussion out there. Just pulling up my screen here. For some reason, the screen I want is not coming up. So we'll do this screen. Okay, let's try and see if this works. I was trying to add my window, but today let's do this. Actually, I'm just going to change it up real quick. So yeah, lots going on with the silver market. Bottom line, though, in my best estimation, because that's what it is, there's just a lot going on out there with silver. And the reality is the reason, I think they moved the settings around on this. Sorry, guys. It's like, so it's.
We got it. We got it right here.
Okay. All right. So you're always updating the technology we use to broadcast. So then when they change something, it's like, oh, what are they changing? So this is the silver price. This is looking at the 4-hour chart. You can see on the silver price, these are candlesticks. They represent a period of time in the market. So each one of these candlesticks here represents 4 hours in the market. I like the 4-hour chart sometimes when I'm just trying to get a sense of more of the short-term pattern. And there's a really interesting, you could maybe argue this as a triple top, although I don't love it as a triple top, but you could argue it, which could be a topping formation for silver. But it's a descending triangle, which is usually, not a good thing for price. And a descending triangle, you can see how it's winding up. And then from a probability standpoint, it's going to fall below that 70 threshold. And then we'll see it go down further. The rumor is that because China is putting these controls on silver, and as of last night, apparently they blocked $50 billion in silver imports. And the reason silver is so important right now is it's industrial material used in all solar panels. And there's a deficit of the amount of silver coming out of the ground. And so there were a bunch of big banks that had a lot of shorts on silver, and those shorts got unwound because a short squeeze started because China came out and said, hey, we're not going to let people take silver and whatnot out of our country. And then Trump apparently is meeting with the foreign ambassador today. It's that big of a deal, right? Where Trump called for an emergency meeting with the foreign ambassador to China because the pricing. So the rumor on the street is that, and this is just a rumor, right? We're not trying to spread rumors, but this is at least what's being told out there. And that the silver price is being pushed down physically because of these short squeezes. And there's, I guess, two major banks, and no one's saying who, are basically over leveraged on the silver trade. And if they let the prices keep going, it's going to bankrupt two massive banks. No one knows which ones, right? But over the weekend, oddly, a couple banks tapped the reverse repo market, where basically went and got money from the Fed and they injected $80 billion in the economy. So something's afoot, something's moving, and they're keeping it quiet, but there are definitely holes being plugged in the battleship here when it comes to silver. But so it's interesting. So this is what we would call paper, the cost of the silver futures right now. So right now the price is 72.82. Well, how far is that run? Well, you can see, it looks like a stinking meme stock. And you can see back at $32 in early 2025, or call it April of 2025, we were way down, and we've just run up considerably. The idea is that there's just not enough silver coming out of the ground for the needs, and so we're up 155% from today's point from that bottom there on April 7th. That was when the whole tariff panic started, and then it just ran from there, which makes sense when you think about it, because if all of a sudden we're going to get in tariff fights and so much of our precious metals come from around the world, that would push prices up. Why? Because we don't really let people mine that much here in the United States because of all of our environmental regulations. So it's much easier for miners around the world to go pollute streams and deface forests and cut off tops of mountains in other places around the world than it is to get it through and do the same here in the United States. So if we're going to get in a fight with the foreign powers that be, whether that makes sense, that would push up the price. But there's already a shortage. They say that about 82 million ounces of silver come out of the ground from all the miners around the world. And there's about a 220 million deficit in the amount of silver coming out of the ground for what's being demanded just from an industrial standpoint. And a lot of miners don't make a lot of money. They don't mine silver directly. It's a byproduct of gold mining and copper mining and others where they focus their mining capabilities on. And so just to increase silver production is pretty difficult. So then that shortage of supply pushes it up, but it happened. And I guess there were a lot of banks who were really short silver. So when it pushed up above a certain threshold, that put a lot of these banks out of the money in their trades, and potentially facing massive issues when it came to solvency. That's at least what the rumor's saying out there. That's what people are talking about. To the degree what it's true, I don't know. So I did a little test earlier on today. I like silver and gold. And so, and this is not, I'm not vouching for SD bullion. There's lots of places to buy gold and silver. I think most of them are scams. But so you do your homework, do your research. But I've certainly found pricing at SD bullion to be most, it's most consistently if you're buying online. And so this is what's called an American Silver Eagle coin. So an American Silver Eagle coin is minted by the U.S. Mint. It's largely looked at as one of the most likely to not be be fake, and people trust that it's accurate because it's U.S. Mint. There's lots of places you can buy silver, but the Silver Eagle and the gold and the Gold Eagle are kind of staples in the world of stackers of gold and silver. So I was like, well, what the rumor on the street is that silver price is one price. So you can see it's being priced in at 72.82 an ounce. And then if you go buy a silver coin, which is a 1 ounce silver coin, if you buy 1 to 19 and you use a card, Bitcoin or check or wire, one of those payment methods, you pay a different price. And you can see, like, if you use a card or PayPal, it's $88 for an ounce of gold on a Silver Eagle. The reason a Silver Eagle is sold at premium, right? Premium, what do I mean? Above 72.82 an ounce, selling at a high premium right now because there's a lot of demand for people to buy silver because people are feeling like this is a dip right now. I don't think that's necessarily true based upon the chart. But just for giggles, in preparation for this show, I went on SD Bullion. I bought some Silver Eagles because I had heard rumors that orders were getting back ordered and that you weren't able to fill your orders. Like, you might go on and buy, but they're like, hey, we don't have Silver Eagles right now. We'll get them to you when you have them. And I was able to go on and buy today at a very elevated premium. So I wouldn't recommend that to anyone, but I was just, as a way of testing, I wanted to see if I could actually buy the physical silver, or how much the demand was for silver, because some of the other YouTubers I watch that are silver suppliers, etc., they were talking about how they have no inventory. They've been just absolutely cleaned out in the coin shops when it comes to silver. When the price ran up like it did and then went down, this brought a lot of buyers back into the market. And you can see this on the chart. You can see that anytime it gets near this $70 an ounce on the chart, that the buyers are stepping in and buying this. Now, this is paper, right? This is just on paper. This isn't real. And so one of the concerns right now in the futures markets, if you buy futures in silver, that you actually can't take delivery of it. So the way futures work is saying, hey, I'm going to buy 1,000 ounces at the end of January, and I'll pay this much for the future. Well, that future, if you don't get rid of it, you're actually going to take delivery of that silver. And that's the way that silver miners, gold miners, farmers, that's how they hedge against fluctuations in price with their goods that they're selling or producing. So when we've got silver in this state, people are saying, well, China's not letting you export it now. Apparently, Trump's going to talk with the foreign minister. The paper price is different than the physical price is. on paper, you can technically buy it for 72 an ounce, but if you buy the actual physical, you're paying quite a bit more for it. You can see this is another source of silver. So right now, the bid ask, you can see it's at 73.49 on the market for an ounce of silver. But again, you can't buy it for that because there's a premium. So then you say, okay, well, can I, buy it for even cheaper? And so these are all different types of ways in which you can buy silver. And so let's go to something that say is less demanded than the silver eagles because they're kind of the gold staple. But if we look at just a silver round, which a silver round can be anyone can mint that basically and create it. And so on a silver, and the reason that you pay less for a silver round that's not from the U.S. Mint is because the theory is that it would be harder to sell potentially because it's less recognized. A buffalo is very well recognized mint, but you can see $83, but you're still well above the 72.80 here or the 73.49 price for buying a silver buffalo. And then you go down and then you just start finding like generic things that you could buy. You're going to pay less and less because the idea is if we ever go to a world where we're, exchanging silver rounds for money, for value and food and that kind of thing, that these kind of more generic rounds are going to get less demand and people will be willing to pay less because they're less recognizable than others. And there's lots of people that create these silver rounds for different, interests that they might have. So you can see anyway.
I'm gonna jump in there because hearing the idea that I need to use a solid silver coin to buy a piece of bread sounds kind of insane. And yet, Chris, a lot of times these precious metal spikes are not random and they indicate stress.
Yeah, that's right. I mean, if you look historically over long periods of time, anytime you get a huge spike in the precious metals, over a 2, 3, 4 year time period, it's usually indicating stress under the hood. Now, I don't think you're going to be using silver to buy bread or anything. I wouldn't go that far, but usually that's there's a shift afoot of the the monetary system in some way, and it probably is only going to be clear in hindsight what that is. But I think global sovereign debt has a lot to do with it. It's not just the U.S. Globally, countries are in a lot of debt, and historically, when that's happened, it's led to unrest and issues, and that drives up precious metals.
Yeah, so I don't want to freak anybody out, but I just that's kind of the context of the conversation here, which is that we're trying to draw a narrative out for why you would see this type of activity. And Daren, this is one of the potential causes.
Well, and I think we mentioned it many times on the show for those long-term listeners like Chris's dad and my mom,
and my mom
and your mom. So
none of our wives.
No, they're too smart for that. So when when Russia invaded Ukraine, one of the things that the Biden administration did is they said, hey, we're going to confiscate all the dollars that Russia has on reserve with us. And the reason why that was extremely problematic for the world and the dollar is that it basically told every country that, hey, if you don't play by our game, we're just going to take your dollars. We had never done that up until this moment in history. And it sent these shockwaves through the world where these countries started saying, we better start keeping our reserve value in gold and silver and these precious metals, because if we don't play the U.S. game, then they're going to take all of our dollars. Well, lo and behold, look what China's doing, right? Like you've seen a lot of talk about Taiwan, and they're like, we're going to take Taiwan. It's ours. We're the rightful heirs, blah, blah, blah. Whatever their narrative is, the reality is they're trying, I think, from just reading through the headlines here, that they're trying to grab the market of gold, grab the market of silver, and preserve as much value as possible, because when the dollar goes bottom up, because at some point it will, with the way we're printing dollars, then some of their, the person who has the most gold at the table is going to have the most voice at the table. And that's why people say that Commander Xi, dictator Xi for the Chinese government, has said, you're not taking any silver out of the country anymore. And that's what got Trump really upset. So one of the arguments, or one of the beliefs, and one of the reasonings for why people are suggesting that gold is going up, that silver is going up, is because you have macroeconomic and geopolitical policy afoot. When Trump came in, he kind of came in and did his very brash kind of like, hey, forget your BRICS. But if you remember, before Trump got in, there was all this talk about BRICS and the BRIC countries, and then they were going to create their own or their gold-backed currency. And Trump came in and said, yeah, no, you're not. And we're going to tariff you to the gills for doing it. Well, one of the ways they've worked around that is they're buying gold, silver, and spades. And that's pushing up the price and pushing up the demand. And if you already have a shortage of silver, because we're using it in industrial products like in solar panels, and with the advent of all the solar panels, there just wasn't the industrial production to support that much silver use. And like I said, it's a byproduct of mining. It's not generally something that companies mine for, because it's never been worth that much. It just takes too long, especially in the United States, to get the mines up and going and the infrastructure approved and all that. So anyway, long conversation, but that's what's going on in silver and gold. And while it is in just kind of a paradoxical way attached to this world of like AI, where last year it was all about AI, and I think this year will be a lot about AI. I think it's still going to blow our socks off as a country and as a world. It is just kind of paradoxical that there's this return to these hard physical assets in a world where everything is quickly becoming not physical, but digital. So let's talk about the S&P 500. So where's the S&P 500? So the S&P 500 is the largest US-based stock. So it's often what people think about when they say, oh, the market. They're really probably just talking about the S&P, the Dow Jones. We tend to look at the S&P because it's 500 versus the Dow Jones, which is only 30. And it's, you can see this downward kind of trend line. It breaks above and then got rejected here, rejected right here, went up, broke out, got rejected, came back in. And the fact that it broke out, came back in and tested this support on this downward trend line and also held this trading average here, it tells me we're probably going higher. Probabilities are in favor of S&P 500 going higher in the next couple of weeks. Now, typically we get these kind of bursts in February or in January, and then we, again, going back to our seasonality, it's never right all the time. It certainly wasn't in September this year. And then we kind of get this pullback that happens going into February. The doldrums of winter set in. And right now we don't have much volatility to speak of. That tells me it could also be going higher. Oil continues its downward trend along that 20-period moving average. Still holding that 56, but it's looking like it's getting harder and harder to hold that line. So I would expect to see some movement in oil here in the very near future. Interestingly enough, we've seen the Trump administration moving on all these oil boats in these shadow fleets, right? Like, everyone hates what Russia's doing, but we've been just letting them push oil around the world for the last 4 years while they were killing people in Ukraine. Or, if you're in Europe, buying their oil. It's, I think, the fact that there has been a lower oil price, there's been a glut of oil. It's certainly given the Trump administration room to mess with the Venezuelan government, because if oil was higher and there wasn't so much supply out there, then it would create too much of a supply shock to go after Venezuela. It appears over last week we dropped a bomb on them. The CIA did anyway, but no one's really talking about it. But certainly Trump mentioned it once. And now Maduro, as of today, is ready to talk and give the United States anything we want. So we'll see where that leads, which is interesting. Doing some research over the last couple of weeks, Chevron until just recently has been very, very active in Venezuela in pumping oil out, so here we are like, oh, this communist regime, but Chevron's in there working with them. And then more recently they kicked them out, but I question that a little bit. So looking at our dollar continues its downward trend. Chris, why is the dollar going down now?
Well, currency values matter for a lot of things, but for one that we've saw during 2025 is that it's a tailwind for foreign stocks. Like one of the reasons why foreign stocks have done so well is that they are earning in other currencies, and those other currencies have strengthened versus the dollar. Currency values matter a lot, and typically the dollar goes up in value during times of stress. People flood money into the U.S. as a safe haven. We did not see that in April. We saw a sell-off in the dollar. And some are saying, it's maybe a start of a new regime where interest rates don't go down in crises and the dollar doesn't go up in crises. So we'll see. But that could be another symptom of the excessive debt in the U.S. and other countries.
But you can see when you look at the chart for the dollar, it's just hovering on this $98 or 98 cents on the dollar. This is DXY. So this is the US dollar in juxtaposition to other currencies. It's actually good for our mid-cap stocks. It helps us export, etc. But it's looking to me like it's probably going to go lower from a probability standpoint. It just doesn't seem to have the strength to keep pushing up. And that can be beneficial. I would expect we're getting close enough to the election that, the people who are not in power are going to be doing everything they can to make things look really bad before the election. And the people who are in power are going to be doing everything they can to make things look really good before the election. And that cuts across the aisles, right? At the end of the day, like even the Democrats, if they're not in power, they're going to do everything they can to make things look okay, because then they get to keep their seat. Unless they can completely pin it on Trump and his admin. And vice versa, when the Democrats are in power and the Republicans are like, they will play along to some degree with the other side. But I think that's just, we're getting close now. So I would expect this year, again, not knowing, this is just kind of a throw a dart, you expect a fairly positive year going into election, unless someone can figure out a way to engineer something naughty to get these politicians kicked out. We look at the bond market. The bond market is an ascending wedge, just like when we talked earlier about silver on a descending wedge, which tells you it's probably going lower. If you look at oil, we're probably looking at it, or not oil, excuse me, at the bonds, you're looking at an ascending wedge here, where it's bouncing up and then looks like it's going to go to the upside on the breakout. So good news for our friend Chris. The bond market looks like it's in pretty good shape for going higher. Bad news, bonds go higher. Usually these stocks are struggling a little bit, but we'll see. And when we look at the 10-year Treasury bond, U.S. government bond, it's just hovering around this long-term uptrend. But I do think we look at kind of a shorter time distance. You can see today it traded down into this support area, found really good support, then it broke out up here. So I think our 10-year is going higher. Bad news for our mortgage rates, because if 10-year is going higher, mortgages will probably go a little bit higher. What I think is interesting though right now, and I was looking at this earlier, is you've got kind of this support area on the mortgage. This is more of a responsive chart, so I don't know how many data or signals we can take just from the mortgage chart, but it looks like mortgages are going lower at the moment, but with the 10-year going higher, hard to see that happening unless Trump just says, screw it, rates are going down, we're getting close to the election. And I think you're going to hear more and more heat from the Trump administration putting pressure on the Fed to lower rates even more because they want to stimulate the economy. There's about a 9-month lag though, give or take, on moving the rates. So the Trump admin knows they've got to start lowering here pretty quick to put stimulation back into everything. I think for today, we kind of went on quite a bit of a road and journey with silver, but hopefully that was helpful to hearing about what's going on, because you're certainly hearing about silver in the news. And we'll keep an eye on it, and next week update you with what's changed.
Thank you for that, Daren, and thank you for checking out our show today. We are on the markets for Mata Advisors, our private wealth brand, Sonoma Wealth. Daren and Chris are the managing principals. I'm the marketing director. Wherever you found our show, make sure you subscribe. It's the easiest way to stay up to date with us, and you won't miss future episodes. And you can learn more about Sonoma Wealth at sonomawealth.com. We will find you next week. Have a great 2026.